for the open session, and we're on item 9B, corporate governance update, proxy voting, etc.
Good afternoon, members of the Investment Committee. My name is Simiso Nzima. I'm an Investment Director in Global Equity. Jumping straight into the presentation, really this slide 3, really shows the closeout of the 2018 proxy season. And really there are two takeaways that I would like to leave the Investment Committee with. The first takeaway is that engagement works. And by this, I mean that if you look at that slide, 39% of companies that we engaged on corporate board diversity, that's 198 of 504 companies have added a diverse director to their board since the engagement started in July 2017. The second takeaway I would like to leave the investment committee with from this slide really is that we will utilize our active ownership rights to affect changes at portfolio companies. By this, really what I mean is if you look at that slide, we voted against 468 directors, 845 companies where our engagement efforts on corporate diversity didn't produce productive returns. So these were board chairs, nominating and governance committee members, as well as long tenured directors. And also another example of that is we voted against 43% of say on pay plans, which is the executive compensation plans, where we felt that the pay was not aligned with performance. And the third example of that is really the activities that we ran in terms of shareholder campaigns, where we, we targeted 146 companies and we had settlement with about 125, and we run proxy solicitations in 17. Moving on to slide 4. Here really we're giving you a preview of the 2019 proxy season. And again, I just want to focus on 3 takeaways from this slide. The first takeaway there is that we're going to apply a laser-like focus on 3 main areas: climate change, corporate board diversity, and compensation. The details on each of these 3 main areas are included in the appendix, and I'll be taking questions at the end of this presentation if the investment committee has any questions on those. The second takeaway I'd like to the investment committee to remain with on this slide is that with climate action engagements, we are seeing notable successes at companies. Companies like BP, companies like Shell, Excel, Glencore, AP Mask, which have gone out and publicly committed to actually implementing the Climate Action 100 engagement goals. So the different commitments, but each one of those companies have actually gone out and acknowledged the role that has been played by the Climate Action 100 engagement. So that's the power of having $32 trillion, behind an initiative. And the last, the third takeaway from that slide really is that we'll continue to enhance our proxy voting, practices in order to make sure that we have effective tools to hold management and directors accountable for creating long-term sustainable value. And again, all of these are actually covered in the appendix, and that concludes my prepared remarks, and I'll take any questions.
Okay. Well, so far it looks like committee members have looked at it and have determined that the report is complete and they don't have any questions.
Thank you.
Okay, thank you. We'll move to item 9C, the divestment overview.
So now I would like to call team member Keith Crocker come up to the table.
Maybe.
Okay, just give us a moment.
All right, we'll just take a moment.
Okay, while we're waiting for Keith Crocker, Dan Bienvenu will soon take on the item.
Okay.
All right. Sorry for the delay here. I had to scramble to find our talking points.
Okay.
So hopefully Kit will be here soon because she's definitely the expert on the if we go deeply into the divestment stuff. But item 9C just responds to Mr. Perez's request for to come back and talk through divestment. Remember, we talked about doing it in April. We were able to do it in March, and we actually thought that given item 7B, it made sense to have the conversation here before that. So the board's policy on divestment is in the total fund policy, specifically section 7, related to and then parts of the appendices. It represents our fundamental direction to staff from the committee on sort of how to analyze the topic of divestment. All new divestments come before the committee for initial determination whether divestment, as proposed, affirmatively supports the board's prudent stewardship of the system's assets, and to ensure prior investment decisions are also supportive, continue to be supportive. So prior divestment decisions. So recall that the way that the policy is currently written, annually, the board's general pension consultant comes forward with an analysis, or not an analysis, I'm sorry, just a high-level demonstration of the economic impact of the various divestments. And then every 5 years, we do a deeper dive review into all of the active divestments. Let's see here. The tobacco divestment was originally done in 2001 and then was reaffirmed in 2016 and even broadened in 2016 to apply to external management as well as internal management. The thermal coal divestment was implemented in 2017, and the 5-year reviews of all 6 active divestments are scheduled to come back in 2021. And the 6 active divestments are tobacco, emerging markets principles, Sudan, Iran, firearms manufacturers, and thermal coal. So attachment 2 is Wilshire's summary of the performance impacts, and Wilshire is also available to walk through their performance impacts. And with that, we're happy to take any questions.
I don't have any yet, but I'd like Wilshire to step forward, and particularly in the illustrative example of methodology to go through. So we level set for all the committee members on how the math of these kind of evaluations is done.
Good afternoon, Steve Foresti from Wilshire Consulting, and Mr. Chair, to your comment and request. I'm going to, before getting into the numbers of the analysis and how our estimates look through the most recent fiscal year, I did want to spend a few minutes talking about the methodology and going through an illustrative example, both for the benefit of new committee members, but also in some follow-up to some of the Q&A we've had in the past, and hopefully to provide some clarity around exactly what is baked into and represented within the numbers that we provide. So on page 2 of attachment 2 is essentially this illustrative example, and I've set it up hopefully to be fairly straightforward and document a couple of points within the process. The first is just how the divestment of individual securities within the portfolio are redeployed or reinvested elsewhere in the portfolio. So I'll just walk you through this exhibit, and it's created to just assume a very simple portfolio with 4 securities, security A, B, C, and while it's not labeled D, security D here would be the restricted name. So if you're moving towards, Dan mentioned these 6 active programs, just think about this being an example of one of those programs and the restricted name being one of those names that would be divested or removed from the portfolio. So to set this up, I've just created this 4-security portfolio at $100 worth of investments, obviously much smaller than the scale of the CalPERS portfolio, and have just kind of made up allocations to the 4 securities: $45 to security A, $27 to security B, 18 to C, and then 10 to D, which again will be the name that we'll remove. And you can see again it's a $100 portfolio, so those exact dollar amounts are also the weights to those securities. The column then immediately to the right of those weights would be the assumed returns of these securities within a given period. In all the analysis that I'll share with you, we look at this on a quarterly basis. We compute the impacts on that quarterly basis and then accumulate it through time. So just think about this example as a quarter's period of time. So those are the returns for the 4 securities in this hypothetical quarter. So 10 and 10.25% for security A, 10% for B, 9.75 and 9.5. And then as we move from left to right in this example, we're now showing to get from the unconstrained, and by the way, just in terms of terminology, I'll use the words constrained, unconstrained. So unconstrained would be the global equity benchmark before removing any names from it. And then constrained or divested or restricted would be how that portfolio looks after having removed names and redeployed those assets. So by setup of this exercise, security D is a restricted name. The $10 that are invested in that security need to be redeployed to other securities within the portfolio. That is not equally distributed. It's in fact, though, distributed based on the relative weight of those remaining securities. So in the weights that I had set up here, those $10 are actually reinvested into securities A, B, and C at $5, $3, and $2 respectively, pushing their dollar investments and weights in the constrained divested portfolio to 50%, 30%, and 20% respectively. When running those same weights across the returns, you'll see that in the first portfolio that included all 4 securities, there was a return of 10.02% in this period of time. After having removed divested security, the restricted security, and redeploying those assets, you can see that the return to the divested portfolio in this example is 10.08%. So it outperformed the unconstrained or the broad index. Essentially, your index vendor who provides us with data for these analysis is performing this sort of mechanics behind the scenes for each of the divested portfolios. So whether it's tobacco or EM principals, Sudan, Iran, et cetera, this is essentially what's happening behind the scenes on the returns that were provided. Wilshire then, in this particular case, would be receiving from the index vendor a 10.02% return for this period for the broad unconstrained index, and for the divested portfolio, 10.08. And we'll get that information for various quarters through time. So as we move from there and to the bottom part of this exhibit in terms of what we do with that information and how we convert those returns to dollars, I've circled at the top here the 10.08% and the 10.02%, kind of brought them down to the bottom exhibit. And essentially, we're going to take the return to that divested portfolio, compare that to the unconstrained or the broad starting portfolio. The difference in return, in this case, roughly 6 basis points, is then applied to the total dollars that are affected by that divestment program. So in this hypothetical example, I have a $10,000 portfolio. In the case of CalPERS, it would be applied to your global equity portfolio, somewhere in the 150 billion range. So working through the math here, at roughly 6 basis points on a $10,000 investment, that contributes for that particular quarter $5.75. It's not $6 because the 6 basis point, it actually has a little more precision underneath it. But for that period, that's essentially the way the methodology would try to capture what the impact. So it would be a gain of $5.75 in this period. The exercise then accumulates these gains and losses in individual periods. So I've just simply shown here, if we came into this illustrative period with a gain of $100 from previous impacts in quarters, how do we get from that $100, add the $575 to the new number? This is kind of the last wrinkle in the process. It seems like you would just take the 100, add the $5.75, and have $105.75. The one wrinkle is that as we bring these figures forward, any previous gain or loss is essentially, if you think about its impact on the overall asset base or value of the fund, is carried forward and grows or shrinks with the gains or losses of the total portfolio, so the PERF. So I've shown here, hypothetically, the PERF had a 10% return in the same quarter. So the $100 that came into the quarter grows at a 10% rate. That turns into $110. We add to that the 575 from this period, and at the end of the period have a gain to this particular divestment program of $115.75. Gone through a lot there, and maybe before touching on program by program what these analysis lead to in terms of results, I'll be happy to, just on the methodology itself, field any questions you may have.
No, I think you can proceed.
Great. So turning to page 3, there's 2 tables here, and this is a summary of the 6 current active divestment programs that CalPERS has in place. The top table shows our estimates of the impact of these programs from inception to date. So for each of the programs from their first divestment period, when they were first, when these securities were first divested from the portfolio, and again totals those through to June of last year. So it's through your most recent fiscal year end, June of 2018. So you can see that of the, and then I'll get to the bottom part in a moment, but that's since the last affirmation, Dan mentioned your policy to affirm these programs now on an every 5-year basis. So starting with the top table, 4 of the 6 active programs currently have generated gains. So the divestment activities have actually contributed in a positive way to the asset value of the fund. 2 of the programs have negative impacts, so losses inception to date. The longest standing divestment program, tobacco, is obviously the biggest contributor, and you can see here that our estimate through June of 2018 is a loss to the fund of nearly $3.6 billion, or 1% impact on the total asset value of the PERF. We show for each program the inception date. And then again, so if you total these up, again, the other loss is a small loss of $11 million to the firearms divestment. The other 4 programs all have gains. So EM Principles, $594 million, Sudan and Iran, $200 and $138 million, respectively, and then the most recent divestment program, Thermal Coal, a gain of $108 million. Those all total, so if you think about all contributions from the active programs since their inception to an overall estimated loss to the portfolio of just over $2.5 billion. So just touching on the bottom chart for the same 6 programs just simply repeats the exercise but shows the estimates from the last affirmation. All the numbers here are exactly the same with the one exception of tobacco. As Dan mentioned, the board in December of 2016 went through the affirmation or reaffirmation process for tobacco. So in that case, the reaffirmation was at the end of 2016. The figures we show for tobacco then are for the 6 quarters, basically the 4 quarters of 2017 and the first 2 quarters of 2018. And that actually turns that pretty substantial loss to the fund since inception to actually, through those 6 quarters, a gain from tobacco of nearly $500 million to the plan. You'll see a column here that says program affirmation, and it says pending for all, but 2 of the programs, again, it says yes for tobacco because you've gone through that reaffirmation within the last 5 years. It also says yes for thermal coal, because that program was just put in place in 2017, so it's not stretched out to the 5-year reaffirmation period. The other 4 programs are pending this reaffirmation process. So, Mr. Chair, I'll pause there and be happy to take any questions that the committee may have.
I don't see any at this point. Oh, just a minute. Mr. Perez.
So in the last 6 quarters, you said that tobacco performed less well than it had since we started the divestments. So it saved us money being out of tobacco?
In the last 6 quarters through June of 2018, it was additive to the tune of $490 million to the total fund.
sorry.
So it worked off some of the losses from prior periods. And if you think about what's kind of underneath that from the numbers I went through on the methodology, that essentially suggests that for that 6-quarter period of time, tobacco securities underperformed the rest of the market, so that divestment and redeployment of assets into other securities outperformed what the index would have been had it included those tobacco securities. And just incidentally, I won't go through it, but the appendix has for each program annual impact snapshots, so you can see year by year, what years were a gain, what years were losses, and then we show the accumulated, both from inception and, in the case of tobacco, since last affirmation.
So in your last evaluation, when the board reaffirmed, was it your opinion that it would cost the fund money to remain divested?
Was it our opinion?
Long story short, should we go back into tobacco? Will it make us 1% that we lost?
I think that's a much broader question. And so our view on these divestment programs has always been around the cost to divest and the decision of engagement versus the cost. But in terms of the report that I've provided today, it's essentially a forensic just measurement of what the impacts from those decisions have been. But for example, at that December 2016 committee meeting, there was outside experts brought in on their view of the industry, what its prospects were versus the rest of the portfolio, and those sorts of opinions. Our opinion letter around that was essentially to try to minimize the cost of transactions, which would have been the same opinions we give when you're considering a divestment activity, which is what's the expected payoff versus the cost. We know the cost. The estimate of how it's going to hit returns is much harder to predict.
Dan's chomping at the bit.
No, I'll just comment. Your question is a perfect one, and it's one of those things where if we had a crystal ball, we would know what the answer, what the perfect answer is, and it just speaks to the challenge around any of these things is that we don't know what the next 1 year, 3 year, 5 years is going to look like. We don't know what the market's going to do. What we do know is that, and the reason that the principles are written to be preferring engagement versus divestment is because what we do know is that if we constrain the opportunity set, Ben's more of a mathematician than I am, but I at least have a quantitative background. I can tell you that anytime you constrain an optimization function, you can only get a worse solution. So that's our big, underlying conceptual concern with divestment. However, what these companies are going to do tomorrow or next year is, if we knew that, we'd all be billionaires. So,
and if I could just add one comment. So on page 5, I mentioned the cost for the transactions versus the impact from what markets do. Within our analysis, we try to capture both of those impacts. So I talked about in the illustration how the return or the market impacts accumulate through time. The other thing we capture are the trading costs to divest. So you'll notice, and I apologize, I can't read what the headers are because I'm legally blind, but there's 2 columns in here. One is essentially the market impact, which I described earlier, but you'll also notice that there's a column for the transaction cost aspects of it. You'll see that that is blank in all but 2 of the periods, and that was when the first divestment happened. So again, one of the certainties we know about divestment is there will be a real trading cost when those securities are traded and reinvested. We know that's going to be a negative. The impacts we don't know. We know that's a risk. It could be positive. It could be negative. You will see upon that most recent affirmation another negative number that came into that transaction period, and that is, as Dan mentioned, where the program was extended to broader reach within the portfolio. So, we very much focus on the known costs and then try to just understand the risks around the unknown outcomes of just how market performs, but very much agree with Dan's perspective on the opportunity set and systematically just narrowing that opportunity set.
And then I would submit to the chair, maybe to ask the staff or direct staff to bring back their evaluation and to responsibly, as far as investments, not so much social, but responsibly investing back into tobacco.
So we did an affirmation. What year was that?
It was December of 16.
December of 16. Is that correct?
Yes.
And as I recall at that time, I asked the question of the staff, left to your own devices, would you go back in or not go back in? And the answer was we would go back in. Recognizing you could not forecast what would occur in terms of price movement in the future. So we now have a program set up for each of these specific areas to a reaffirmation every 5 years. Is that
Yes.
correct? With,
Yes,
with an annual
Yes.
review, but an affirmation process, essentially an action item every 5 years.
That's right. The annual review is by Wilshire. It's high level. It's just basically a version of what you see today of the estimated impacts, performance impacts. And then the deeper dive every 5 years is by staff.
Yeah, and that's when normally, according to our current policy, we would then make a decision about whether we want to change our strategy
Yes.
in regard to these investments. So the next time this is scheduled is 2021?
Yes.
Okay. So if we want to change that policy, that would need to be in the form of a motion if we were going to do it sooner than that.
Motion.
And, all right, so we have a motion to, we don't know the timing yet, but we're talking about,
Next month.
well, I think next month it would be difficult for them, but let's put it this way, very soon to do it. That would be the motion. Is there a second to the motion? Second. All right, so motion from Perez, second from Brown. Discussion on the motion. Ms. Taylor, do you want to speak?
I can discuss on the motion too,
Sure.
but I would like to go back and talk about some. So first, I would say I don't support the motion. We have a process set up to do this. I will also say that what I was going to say on this was that if we get back in tobacco now, we're also buying back in tobacco at a high. We lost a little bit over 6 months. But after all the $3.5 billion that we supposedly lost, now we're buying into it at a high. So be prepared that we may not make any more money on the tobacco stocks. But secondarily, something that's never figured into this is we also provide health care. And no, this is not a consideration, but it is something that we should all look at. We also provide health care. So if we're invested in tobacco stocks, we're also costing our health care increases.
I would submit, ma'am, that,
No, we're not cross-talking here.
I don't know how it would.
So, but
wait.
second, also, we, since we have it started declining, one of the things that I think I was going to ask Wilshire and maybe our staff is that if it started declining now, and you said that it's hard to say whether or not we'd get back into it, or what forecasting would be. At this point, are you seeing a forecast for it to go down? Is that why we've lost in the last 6 quarters?
So that is the rationale for the every 5-year review, is that it's a pretty deep dive, and we can go out to sell-side analysts, buy-side analysts,
Right.
and do the whole review, and that's what we did, recall, last time. Our recommendation was to not divest, but of course the board took the action to go ahead and to divest, as Mr. Slayton said.
Well, we were already, let's be clear about this, we were already divested. You wanted us to reinvest, correct?
We were partially divested. It was out of our benchmark. External active managers could invest as an out-of-benchmark bet. The internal strategies did not own it. It was precluded from the internal strategies, and the board's decision at that time was to actually expand the divestment to the external active strategies.
Okay, so again, I speak against this motion. I think that we have a process set up. We are currently losing money on tobacco. I don't see any sense in buying in at this point, especially, I just think it's a mistake for us to exit the process and try to do it outside the process.
Mr. Miller.
Yeah. I actually think the timing to be revisiting this again in 2021 is probably pretty good timing, just from the big picture of politics and everything else. I don't see anything creating a big drastic change in where tobacco fits into the agriculture industry sector. But, it would be nice to imagine a future where the tobacco industry transforms into the cannabis industry, and that might be fun to look at in 5 years or 10 years. So I've got an open mind for the future.
Mr. Jones.
Yeah, thank you, Mr. Chair. Just looking at the inception dates, because prior to last year, these divestment issues were coming to us almost annually, one at a time. And we said, well, why don't we, this was just last year, we said, well, rather than coming to us every year with a deep dive, let's wait to a prescribed period of time and have them all. So we just made that decision last year to bring all of these back on a 5-year basis rather than year at a time. And I think this is wonderful to see this chart where you can put them together and you see the pluses and minuses. So I would not be in favor of then dissecting and removing them and treating them differently. I would continue to support the 5-year plan to bring them all back so we could then look at them holistically and see where the ins and outs occur, and then make a decision based on the total data rather than one at a time.
Ms. Brown.
Thank you. I'd like to ask staff a bit of a hypothetical question, because if the board was to take an action and say we don't want to divest from tobacco, Mr. Mang, we wouldn't be saying go out and buy tobacco today if it's high. We would just give you the opportunity to buy into tobacco. Is that correct? Who wants to answer that?
Okay, so let me answer the hypothetical question hypothetically.
No, go ahead.
So as Dan just said a moment ago, it's very difficult to predict the future. And I believe that in December 2016, the internal team, as well as external experts, got together, put our best estimate going forward. So if you put me on the spot now, at this moment is a year and a half, almost a year and 3 months after that comprehensive study, I cannot really give you an educated answer. So we need, if that's the committee direction, we had to do a deep dive before I can come back to you with an answer.
Great, but my question is still, we're not, if the market was high, if we're saying don't divest, are we saying you have to go and invest right now if tobacco is high? Dan, you want to give me that one a shot?
Sure. I'll take off the COIO hat and put on the MID of global equity hat.
Thank you.
Yes, this is one where the way that the global equity portfolio is constructed, it's constructed very systematically and mathematically. If these securities go into the benchmark, the vast majority of the portfolio will reinvest. Now, our external managers will still be able to make their decisions. It is the case that the index methodology would apply over some timing, and that's when it would happen. But if we were to reverse that decision and take away the divestment in tobacco, it would go into our benchmark, and the vast majority of our portfolios would buy tobacco stocks.
Great.
Yeah,
and do we know if aren't tobacco companies actually buying cannabis companies now? Isn't that kind of where they're headed?
There has been one announcement that I'm aware of a tobacco company buying a cannabis company. There's also been several spirits companies that have made investments into cannabis companies.
Oh, spirits. Okay, good.
Like Constellation Brands, who makes Corona, they bought a big stake, I think, in Aurora.
Thank you. I'd like
Okay.
the SIN stocks. Thank you.
Okay. Mr. Perez.
I just think it's 1% of the fund is a lot of dinero, and that can go a long way towards easing a lot of the public comment that we got, specifically from the league and the special districts and the counties. And I understand that it's a 5-year cycle, but in light of the fiduciary training I got as a rookie, I'm responsible for past board decisions, so that's why I'm bringing it here. And of course, I'm not doing the work, so it's easy for me to say, but I think it's a worthwhile endeavor for you guys to do a deep dive and to come back and say, yeah, I would, or yeah, I wouldn't.
Okay. Ms. Taylor.
I just want to reiterate that this is already divested. So, and we keep calling it a divestment as if we're currently doing it, and I think maybe we need to change our language. But it's already divested, we're not in it right now. So if we were to reinvest in it, that would take a longer time. And then also, you're keeping track of cannabis. Interesting. No. I just wanted to say that, as I understand it, I think there's one company right now that's in cannabis. I think it's a great idea if they do that, but let's look at it in the years to come after an election when we can find out whether or not that might be legal in the United States. Because right now, we can't invest in the New York Stock Exchange in anything that's cannabis unless it's from Canada right now. So.
Yeah, correct. There is one New York Stock Exchange listed company but it's a Canadian company that's listed. It's duly listed.
Yeah. So just the chair to make just a couple of quick comments. One is I resist trying to time the market. I've listened to enough ads from financial advisors saying that past performance is no guarantee of future performance. So trying to time this is in my book, kind of a fool's errand. The second thing is staff resources to do this, and one of the reasons we put it on a 5-year cycle was because this takes significant resources in order to be able to construct, and so the sense of the board at the time was that doing it on a 5-year cycle would meet our fiduciary responsibility. That was the decision we made then, but we do have a motion on the floor now to take up tobacco in the short term to do a full review of that. Oh, first, Mr. Jones.
Thank you. Just one additional question. If hypothetical, if we were to start changing our policy and reinvesting, wouldn't we also start to see transaction costs going up? And that's coming out of the PERF? Okay.
Yes.
Thank you.
Okay. All right, we'll have on the board, let's have a vote on the motion. Committee members, please vote.
To reconsider the
It is on now.
tobacco.
This is just consider. This is not.
It's displaying up here.
It's displaying.
Yes.
All right, is everybody? All right, motion fails. Okay, do we have more on this particular item before we move to 7B? Kim, do we have anything else?
I assume, and my apologies that I wasn't here at the beginning, I assume Dan covered the basics, so we're good. Thank you.
Okay, very good. All right, we will now move to the item that was delayed, 7B, Assembly Bill 33.
All right, so now it's good afternoon, Mr. Chair and committee members. Danny Brown, CalPERS team member. AB 33 by Assembly Member Bonta would prohibit CalPERS and CalSTRS from making any new or additional investments in private prison companies. It would also require CalPERS and CalSTRS to divest from a private prison company that doesn't transition from their business model to another industry following engagement. Although you've seen the agenda item and you've heard from other presentations that it only appears there are a couple of companies that would be impacted by this bill. Our recommendation to oppose the bill has nothing to do with the size of the impact or the issue that the author is trying to address, but rather our overall policy that we prefer engagement over divestment. And as was mentioned in the prior presentation, that it's important that our investment team has a full set of opportunities in the market as they're trying to achieve their 7% goal. And with that, I'll stop there and answer any questions you may have.
Okay, Ms. Taylor.
Boy, that was quick. It was the only one, huh?
So far.
Huh?
So far.
I will say I appreciate everything you've done here on this. So there's a couple of things. One, there's another bill out there. Are we covering it here? There's another bill out there to make it so that California can't open or invest in any new private prisons, correct? It's like 32?
Yes. I mean, it's AB 32 by Assemblymember Bonta, and it would prohibit the California Department of Corrections from contracting with private prisons.
To outsource?
Right.
Okay.
So
but
it doesn't eliminate necessarily private prisons. It just prevents the Department of Corrections.
Some of these companies are nationwide, worldwide companies, so we can't really impact that anyway. So here's what I will say. I represent state employees, all state employees, 350 or 450,000 state employees. All of those employees work in the prison industry, or a lot of those employees, I'm sorry, not all, a lot of those employees work in the prison industry. And private prisons replace their jobs. So I am absolutely opposed to anything that is replacing state workers' jobs, in addition to the fact that this is a horrendous business model. In general, I won't even get yet to the immigration issue, but in general, private prisons exploit prisoners, treat them badly, pay their employees badly. It is a hugely awful business model. Then when you get into what our current administration is doing and using those private prisons to separate children from their parents and along the border when it comes to immigration, it's just another horrendous practice. And to me, it seems like it's anything to make money, which is great for us, but it doesn't seem like the returns have been all that great. So I was going to ask, can we do this on a neutral? I'm not saying that we say yes to divestment, but can we, rather than oppose, can we say that we're neutral on the Assembly bill right now? Because I don't want to vote oppose.
Yes, you guys have, yes, that is an option for you, the board, to vote a neutral position on the bill.
Okay, so I will also say that I think that it is incumbent upon us to consider how this money is being used as a fiduciary duty, because it is also part of our ESG strategy. So the S in ESG are social. And if you're taking away public sector jobs, you're hurting the pension fund itself. So that's the way I feel. I would like to propose, is it an amendment to the action?
Well, we don't have a motion on the floor yet.
Okay, so I'd like to propose a motion that the board
take a neutral
position on this.
I would second.
Okay, it's moved by Taylor, seconded by Fechner. We have a motion on the floor. Thank you. Mr. Fechner.
Thank you, Mr. Chair. I would support the motion for taking a neutral position, and only because if this committee, this board, chooses to divest on their own from private prisons, that's another issue, versus, in all due respect to Assemblymember Bonta, we can't be dictated to by the legislature. So if we chose to do that, then that's another issue, but we can't let ourselves be walked down that path by opposing a position or taking positions on those bills that could harm us or our fiduciary responsibility.
Mr. Rubalcaba.
Thank you, Mr. Chair. I had a question. I noticed in the bill there's a section 2D that says basically that nothing in this section, the board is not required to take action unless the board determines in good faith that the action described in the divestment is consistent with fiduciary responsibilities of the board. And so, so I support the neutral position, but even if the board would go yes, or we would still be protected because we would still withhold. I mean, it doesn't impact our. I mean, I agree with Mr. Fechner that we have a fiduciary duty. We have an exclusive duty to make this investment decisions, what have you. But a part of that is the fiduciary deliberation. But with this section actually acknowledges that we still retain that right. I just want to. Did you read it that way?
Yes, that is correct. And that's language that they typically put in these divestment bills to give the board the ability to make a financial decision at the end as to whether or not to actually divest once staff has gone through the analysis.
Okay. Thank you.
Mr. Miller.
Yeah, I won't repeat the comments that my colleagues have already made. I agree with all of them. And the only reason I wouldn't be putting forward a suggestion that we should oppose this is because of the language in the bill that Mr. Rubalcaba mentions. It is our fiduciary responsibility. And as I mentioned at a previous board meeting, their business model and some of the things that have come to light that are huge legal liabilities that we expose our to with investments in these firms, where some of the substantiated and lots of the not yet substantiated allegations make Harvey Weinstein look like Mr. Rogers, what's been going on in a lot of these facilities, especially with regard to abuse of young people and people in custody. And so I will support the motion for a neutral vote as well on this bill, neutral position.
Ms. Brown.
Thank you, Mr. Chair. I'd just like to say, for the record, I like the staff's recommendation to oppose this bill. And in my career, I've seen this time and time again. It's a slippery slope. If the legislature comes up with a set of rules and we can do some research and we can do some analysis and then we can at the last minute decide not to divest, the legislature does not tell this board how to invest or divest, and we should always take a position of oppose when the legislature tries to help us make investment decisions. We just need to stay steadfast in this policy and in this practice. Otherwise, we're going to see many more bills come up through the legislature. And I think we need to stay steadfast and hold our ground on this. And we really need to stick with the staff's recommendation of oppose. Thank you.
Mr. Perez.
Look, as a cop, I understand that it should only be the government that takes away your civil liberties, and I think it's shameful that the government contracts out private prisons. To Ms. Taylor's point, that those are dues-paying, PERS-paying members' jobs. That's not the priority. The priority is to make the fund money. It's a strange duality that this board lives in, where we can have a heartburn with this and not have heartburn with what we just talked about 2 minutes ago. I strongly oppose. I support staff's decision. I strongly oppose, but I'm 0 for 2 today. So.
All right. Well, we're not ready quite to vote yet, so I don't have any further requests to speak. We do have the public wishing to make comments on this item. Mr. Jelensik, Ms. Jepson, Mr. Gibbons, and I think Mr. Hutchins had to leave, so. Mr. Johnson. Sorry. Mr. Jelensik, you may proceed.
Thank you. I would like to thank the chair for getting me the copy of the Makita letter. I would oppose the motion and encourage you to go back to the staff recommendation. You do not want the legislature telling you what you should and shouldn't invest in. Granted, they give you the out, but you ought to say, we need to make investment, not social decisions. So I would encourage you to take an opposed position. I couldn't help but notice in the agenda item, a little section says, in addition, the bill states that the private prison companies have incentives to maximize their profits and to minimize their costs. Sounds like asset class you talked about a little while ago. The truth of the matter is, whether you invest or don't invest is not going to change the behavior of these companies. Just as with tobacco, I have not found anyone who smokes because CalPERS might reinvest, and I haven't found anybody who quit smoking because you divested. If you're not changing behaviors, then there's not even a social argument for it. So I would encourage you to say that this is not good policy. If the legislature actually thought it was good policy, they would direct all California funds not to invest in this area, but they're not. So I would, again, encourage you to reject the motion as it currently stands and adopt staff's recommendation. Thank you.
Ms. Jepson, and before you start, Kevin Menaker is on the list as well. If you'd come down, make your way down. Thank you. You may proceed.
Thank you for the opportunity to speak to you today. I'm also in support of the staff's recommendation. A lot of you know me and know that I am a retired emeritus professor from the California State University system. And in the last 40 years that I was teaching, the Chancellor's Office was continually giving us unfunded mandates, things that we had to do, but they were not giving us the funds to do that. We had to pull that out of our regular funds. And I think that's what's happening here with the legislature, that if they were going to indemnify CalPERS for the losses or the additional expenses we had of divesting, that would be fine, but that's not the case here. And personally, I'm not for private prisons. I think putting children in cages is criminal, and I think that separating families is inhumane. But that's really not the point here. The point here is that CalPERS has a process of engagement, and it is a good process. And I think that the decisions to invest or divest lie with the investment team, not with the legislature. I don't know about you, but I don't ask the legislature for investment advice. Thank you.
Thank you very much. Mr. Gibbons.
Chair and members of the committee, Dylan Gibbons with the California Special Districts Association. Our association has taken an opposed position on this bill, as have the California State Association of Counties and the League of California Cities. We believe that divestment as a means of achieving a political objective is not a sound investment strategy. And we're going to try and stop this bill and essentially the legislature from telling you how to do your jobs and how to handcuff your chief investment officer. We just heard in the discussion before that engagement works, and we support CalPERS using their investment as a tool, as a power to affect change from within. This is an opportunity to send a message to the legislature by adopting the staff recommendation that they should not be telling you how to invest your dollars. Leave that to the capable staff. Leave that to your engagement process. If it doesn't work, if engagement doesn't work and you want to come back and you determine that it makes sound and financial decision to divest, then go for it. CSDA adopted a policy on divestment that I want to read to you, that I would encourage you to adopt something similar. But CSDA supports CalPERS' priority to its members, as stated in the state constitution, Article 16, Section 17. A retirement board's duty to its participants and their beneficiaries shall take precedent over any other duty. CSDA opposes any efforts that would divert CalPERS from its duty to its members, including divestment of CalPERS assets to achieve political objectives, if the divestment would have a negative impact on the overall health of the fund. CSDA supports CalPERS' proxy access efforts to effect change from within business. CalPERS has invested in to ensure they are well managed for sustained long-term success. We want to work with you. We want to help CalPERS. What I am asking for you is help from you to stop these bills. It's really tough for me as an advocate to go before the legislature and say this is not a good idea. This is bad. This is a bad investment strategy. If I don't have CalPERS saying the same thing, to stay quiet on what is good or bad investment is not helpful. It's not looking after your fiduciary responsibility. So again, I encourage you to support the staff recommendation and oppose this bill.
Thank you for your comments. Mr. Menninger.
My name is Kevin Menninger. I'm a state workers programmer for the Franchise Tax Board. I respect and appreciate the efforts of CalPERS to safeguard my pension. Thank you very much. I'll be using it in a few years, I hope. I understand and agree that divestment is never an issue to be taken lightly. Only the most egregious moral and or ethical failings could possibly override the fiduciary responsibility of the board in securing its investments. But I'm old enough to remember when apartheid in South Africa was one such issue. And as recently as 2015, the issue of investment in coal came before this board, which then decided to take a no position at all. And now we see forced labor, mass incarceration for profit, the ripping apart of children from their parents at the border. Certainly this is a moral outrage that rises above mere fiscal opportunities. Core Civic and Geo Group together are responsible for about 70% of migrant detentions in the U.S., a vast number of whom enter the country legally seeking asylum. For comparison's sake, let's look at CalSTRS, who oversees, $219 billion? They have about $13.7 million invested in these two companies. CalPERS oversees $359 billion. That's more than 64% more than CalSTRS, but it just has $11.4 million invested in these companies. That's 17% less than CalSTRS, and yet CalSTRS saw their way to divest. Human rights violations of Core Civic and Geo Group have triggered several lawsuits that note their business models rely upon forced labor and medical neglect. Furthermore, sexual assault and rapes that occur in these facilities are rampant and unchecked with minimal investigation, if any. If lawsuits don't create progress, why would we think engagement would? They're not going to listen to us. This is a volatile and precarious industry, as evidenced by the recent performance of the companies in question. In the last 4 years, I think it was, Core Civic's valuation dropped about 47%, and Geo Group lost about 20%, while the S&P went up about 20.5%. So, while many of my colleagues and I are sickened that we might profit from this vile acts, we would prefer to see CalPERS divest from such examples of profit over people. But I recognize the duties of this board. So I urge you, I'm surprised you brought it up, because I was going to urge you to take a no position on SB 33 and avoid the headaches of moral outrage versus fiduciary duties. Thank you.
Thank you very much for your comments. I see no other requests to speak. So we have a motion on the floor to take a neutral position on the bill. I'm sorry?
Point of order, Mr. Chair. So a yes vote?
Microphone. Just a minute.
Thank you. I just wanted to be sure that we're voting on the neutral position, so a yes vote would mean you agree with the neutral position. Is
Right.
that
We
correct?
would be instructing staff to take a neutral position on the bill if
Thank you.
vote in favor of the motion. All right, and it's been requested that we do a recorded vote. So if you'll set up the board. We have 1, 2, 3,
4 to 4.
5. 5. What does it take, council? What is it?
7. No, it's not investment.
Abstain.
Take 7 votes? Take 7 affirmative votes. So motion fails. Oh, wait a minute. Counselor?
This is not an investment decision. So
what's the...
So this is a 6-vote plurality or majority.
So
It fails anyways.
So it fails anyway. It's a
Well-
5 to 4.
But
pardon me?
The chair can vote.
Oh, the chair can vote. I had a hunch this was going to happen. I'm going to vote against the motion. Motion fails. All right.
Can I make a motion to...
just a second. Let me get out of this a second. Okay. Ms. Brown.
Thank you, Mr. Chair. I'd like to make a motion to support staff's recommendation to oppose.
To oppose position. Okay, it's been moved by Brown and seconded by Perez to accept the staff recommendation and take an opposed position to the bill. All right, and we'll have a recorded vote on this one.
We're doing a recorded vote, Pam. That's okay.
Okay, it passed. All right, motion passes. All right. Well, let's see. I think that completes that item. And we'll now move to item 10, summary of committee direction. Mr. Ming.
We took no directions during that session.
Okay. All right. So we'll move to public comment, and I don't think I have. Do we have any? Nope, we have no public comment. So the open session is adjourned, and we'll be meeting closed session as soon as the room is cleared. Thank you for all your participation today.